Hello, good evening, everyone. Hello, good evening. Uh, Barry straight in there. Barry, off the mark. Let's have a look here. Barry, evening all. Christian, good evening all. Good evening. Hi, Duncan. Duncan's there. AI Pete, evening one and all. Brian, evening. Hello, Andy. Got some fireworks going on in my area. As a kid, I used to love fireworks. Now I just think they're a pain because you've got a dog. In fact, it doesn't really bother my dog too much, but I mean, it's not very nice. Mark, hello. Tom, hi everyone. Welcome along. Hi James. James K. Yeah, bangers. I don't see the point of bangers. I understand. Pretty fireworks that it's display, but bangers. What are they for? They just scare animals. Stop doing it. Rubbish. I thought it was an interesting chart today. This is personal group. It's trying to break that resistance there, going sideways, so come down, hit that, dipped, back up, break through that sort of support level there. And I tell you what happened funny thing today. It was at one point, RAMSDENS shot up. Like there, it was no volume. Went up to 364, which is odd. I thought, what's going on here? But you can see there, the sell-off has happened, and they're finding support there, going sideways for a while, which is nice. And yeah, so based off good value, these companies, so they won't fall back too much. It's not like they're companies that are, have no value ascribed to them. They got good value, good growth. Let's sort of Raoul, evening. Darren, evening. Normally listen to the recorded, but I thought I'd pop in for the first 50 minutes before I have to go. Are you doing fireworks, Darren? There we are. Evening, all right. Barry, are you going to Mellow in London, 18th and 19th? No, I don't particularly like lots of people. I don't like crowds. I don't know why that is. So every year I go to, well, I have, from a young age, I went to Cheltenham with lots of friends and from Wales. And I missed it out for 5 years. I can't be bothered doing that. But yeah, I'm going this year, and I'm looking forward to seeing the friends I haven't seen for a while. But the crowds of people, uh, yeah, time. I know it's annoying, isn't it? AB North, someone needs to get to the bottom of what's going on with time. Hiya, Winehouse. Sadly, no folks, just work. Oh well, at least you got some work there. That's good, isn't it? Yeah, so time is annoying, isn't it? I think it's just a little bit of worry about this alternative finance providers. Saying that it's dipped down. When was that? That was in April dip. It's sort of just below that range, sort of where you can. It's in April came down that, so it's lows now. But if you look at time on here, for example, where is it? Time. It is number 8. And in fact, by the way, I'll go through this, but I've now incorporated the new sort of forecasts, 2 years of forecasts. But 73, look at the value there. It's a PE of what, 7, so it scores 8 points. PE of 6 the following year. It's cheap. It's very cheap, and I mean, growth for this year is not going to blow it out the water. But it's 4% top line, 7% top line, but it's improving the year after. So, and this, let's be honest, they're at least in line with this. So I'm expecting them to beat expectations, and so that to improve the growth here. And it's a well-run business. It's just it's unloved. There's some people who keep saying it's subprime lender. And there's a worry about downturns. And like I said, when I spoke to James, the CFO, he said there's 2 times they're really busy. In downturns, when businesses struggle, some businesses go through, but they're very conservative on the lending. But generally, he said, the economy is very resilient. Lots of businesses are very resilient, and they tend to need a bit more cash when it's tough times, and more cash when it's good times. But in between that, which I suppose where we are now, they're still doing very well. So it's one of those things that where I'm not just going to sell it because the fundamentals are good, and I think you're never going to pick it up cheaper than a forward PE of 7. It's so cheap, So I think it's more the buying opportunity than anything, Even though I'm down on it a little bit, but it's cheap. There we are. Yeah, 5th of November, Wednesday weekly webinar. Q4. November already. Welcome to all members, new members as well. If you are new and you haven't tried the chat group, please try that and interact on that if you can. You'll see that picture right there on the blog post. That's where you get the link to the chat group. Tonight's topics, my holdings as always, top 5. I've got to sort this out because, of course, I've changed the algorithm a little bit to reflect forecasts going forward. I'll just cover that again this week, just in case people didn't see it. Topic of the day. So what's new? That's that. Portfolio losers. What to do with them? This is a good thing I want to look at. Because, you know, sometimes just by timing, you buy it at the wrong time, the share price goes down. Fundamentally, if they're okay, so what? As long as you're not, not holding a big position, you're okay. And we'll look at any companies you want to look at on the MICROCAP database. I mean, I've had quite a few the last few days. In fact, look at the calendar. There's quite a lot of results coming up over this month. But so there'll be more to come. But I think ADVT came up with some thing. I mean, less than expected, but it was non-cash. The profit went down, but it was a non-cash thing because of the holding they have in Saatchi. I was thinking today, Saatchi did the John Lewis advert, but it's not M&C Saatchi, it's Saatchi and Saatchi. Two different companies. I don't know if you saw the John Lewis Christmas ad, but they did that. But anyway, yeah, if you want to look at any companies on there, let me know. Let's have a look. Yes. I was wondering what happened to the MicroCap fund. Yes, well, because I've changed the algorithm a little bit. I mean, there hasn't been a huge change. The majority of stocks, the good stocks, they've always been in the top 25. I mean, some drop in, drop out, but the core of good companies stay in there. I will be redoing it, but I sold the holdings in it. But the returns on the companies there, within that. In fact, if you look at the MicroCap, the top 25 now, it's working a lot better. And I did explain last week, and I'll explain again this week why I've changed the algorithm a little bit, because a lot of the forecasts were based on the end of the year. Companies, we are towards the end of the year for many companies. So, they may have a strong 2025. The figures will be reported for 25 in about three or 4 months' time. So we need to see further out forecasts. And even though that was on the chart, so I'll show you. It's a lot easier. In fact, I'll go through it now. Before I get to that, there's some stocks that were like Anpario and SYNECTICS. Yeah, Time and PhD are mellow on the 19th. Okay, Time and PhD and Personal Group are mellow on the 19th. Sorry, MICROCAP fund. Yeah, would like to quick look at ZOTEFOAMS, if possible. Yeah, I did cover those. Is the portfolio spreadsheet on the website? I've cancelled my stock period. Okay. Tom says, is the portfolio tracking spreadsheet on the website? I've cancelled my Stockopedia subscription. Well, Tom, you'd be glad to know I'm now a lot more happy with the sort of metrics and algorithms that we use here than ever. Now, if you look at the MICROCAP League, because I was looking at this a couple of weeks back, and I discovered a couple of companies were in here, and I thought, well, hang on, they haven't got good 2026 figures. The 25 figures are okay, but that year's coming to an end. We need further out forecasts. So I did have just 1 year's of forecasts in the potential section scored, and now there's 2 years. So all these companies see strong potential growth for the next 2 years forecasts. Of course, they're just forecasts. So you have to keep it updated on the trading updates and all that stuff. But hopefully you won't find, or you may find a company with strong growth reported this year or last year, but the growth figures, I've changed the scores. So basically, even if they have a good year just reported, it's not that important. It's what's going to happen is important. So if you look on these are all companies worth looking at, based on their forecasts. So, and I was a lot happier when we did the update and the guy sent to the developer, that's it. Because there was a couple of companies in the last time, I thought, they're not forecasting to do good figures the year after next. And so, because they've had one-off big contracts and they haven't got any next year. And so now these are companies, I think, like if you talk about Anpario, where's Anpario? Is it there? There we are. So number 15. Now, if you look at Anpario, right? Yes, it's risen a lot, but it's a forecast PE of 11. Top line 9%, 11% profit growth. So in fact, next year's good. Year after isn't as strong. So look at these two. This is next year forecast. So when is the figures here for? Yeah. So this is this year, happened this year, but next year it's a little less strong, 14, but it's, it could do better. So it's worth looking into. I'll explain it in a bit, but it's a lot easier if I go through it on the old. Sorry, any other question there? I'll look at ZOTEFOAMS, ADVT. I think you got to look at that. I did the same and now use Google Finance to keep portfolio. Oh, the portfolio, yes, Google Finance. In fact, if you look, you're talking about that. Okay, so if you go to the blog, all right, and click on exposure levels, portfolio management, you can download a spreadsheet there at the bottom. I explain all about that. In fact, there's an article like this coming out, but there's Google Finance as well. You can set up your own portfolio, and it's a lot better actually. It tracks it a lot better. You can manage it a lot better. But also, there's also a portfolio management spreadsheet there, which you can look at your stocks. But I would try that first, the Google Finance one, because of course it's dynamic. Well, the spreadsheets are dynamic; they update it, but it's a lot less fiddly than the thing. So yeah, if you look at that, have a look at that. Okay. My holdings. I bought another stock today, and I'll tell you why. I've got enough stocks now. I'm not going to, buy any more pre stocks. For say that, if an opportunity comes along, I've only got pretty much small holdings, lots of these. But it was Water Intelligence. I just read there. In fact, there should be a dot there because Patrick D'Souza owns 25% of it, which I quite like. Founder, owner operated sort of large shareholders. I mean, you see this, dots on all these companies here. They all have, significant skin in the game, the management, which I quite like. And Water Intelligence is another. But I tell you why, because I've always been a bit skeptical on Water Intelligence, but they've been buying back franchisees, so their debt has gone up a bit, but it's helped them a lot. And if you look down, what caught my eye was the figures were okay for Q3, but so for this year, 13% top line, 15% net profit growth. But I think that's going to be beaten. And I saw the comment from the broker saying, look at this. So they only have to deliver 2.6 million EBITDA in Q4 to beat estimates. And so they're, oh, that's good, considering, so it's 80% cover for this year already before the last 3 months of the year. All right. Now, if you scroll down to my comments, you see that, hang on, in line with expectations, increasingly confident about 2026. So if you look at this is the quarters they've done. Q1, 4.1 adjusted EBITDA. Q2, 5.1. Q3, 4.6. They only need to deliver 2.6 million when the average adjusted EBITDA first 3 quarters is 4.6. So I'm suggesting, or it's a good chance, high probability they will beat expectations. And obviously, I think then that'll be upgraded this year as well. So they'll upgrade 2026 probably as well, because they'll be tracking ahead. I mean, it's in a downtrend. I've only taken a small position on it. But when it moves, this company, I've seen it before. When it moves, it tends to move a lot. And when I buy companies, I'm thinking, 3 to 5 year horizon. I'm not expecting it to go up crazy, but I think if they report, obviously, a Q4 end of year trading update ahead of expectations, I think we'll see the bottom here. So we are in a sort of, that could have been a low, but I bought something here today. Could go a bit lower. I'm not really concerned. I've only taken sort of just less than 3%. But when it tends to move, look at that, the movement. Same with them, ASHTEAD Technologies, 3 to 5 year horizon. But when they tend to move and get going again, the momentum could be very strong on these stocks, especially when you've got someone holding 25% of the stock. So stock available is not a lot. So I do like it going forward. Like I said, they've got a bit of debt, but that's largely due to the acquisition of franchisees. Like I said, I only put a little bit in. I just thought, hang on a sec, that's easy to beat that. They'd have to go do a lot to beat the expectations for the year, and I think that could turn it around a little bit. So, like I said, what have I got in that? Yeah, 2.6%. That's what I've taken. Not a big amount. Sorry. Yes. Yeah, let's repeat. Water revenue compound annual growth rate since 2019 is 20%. Yeah. Water, very good Vox investor interview on YouTube today. Okay, Duncan, thank you very much for that. Yeah, I mean, they were at one point when they were like, I could never understand the valuation on it But if you look at it now, it's literally, forecast PE of 11, dropping down to 10. This used to be like 25, 30 times PE at one point. I thought, bloody hell, it's expensive, isn't it? But these levels, I think, with a chance of beating, a good chance of beating, I think that will go higher, and the momentum to the downside may stop a little bit. So anyway, like I say, I've taken a small amount. That's what it really. It's been a tricky week this week, isn't it? A big sell-off in the American markets. It's bouncing back today. There's a worry about the bubble out there. There's a lot of talk about the bubble. In fact, Steve from the Weekend Podcast said, should I sell my fund? It's a bubble. I covered this on the webinar 2 weeks ago. When lots of people are talking about a bubble, it tends not to happen. You need a shock. You need something left field to trigger. I mean, stretch valuations on their own tend not to do it unless they get this really stupid levels like in the dot-com crash. But a couple of companies started going through that as well. So, in fact, there's an interesting interview. I listened to Wilfred Frost. He does a podcast for Master Investor. He's talking to what's his name? The guy from CNBC who wrote Billions. He's an anchor and a host on that, and he's written 2 books on crashes. He's written Too Big to Fail, which is the Great Financial Crash. He's just done one now on 1929 crash, and he was saying the guy from Merrill Lynch, something Lynch, can't think of his name, warned his investors to sell in 1928. Okay, he said things are, it's bubble territory. Everything's overvalued. Sell. Right? From 1928 to 1929, the market went up by 90%. So that's what happens with bubbles. You find the blow off the top can really get crazy. In the last year of a bubble, it can really get nuts. And you start knowing when you start in bubble territory, you start selling off, you can't make previous highs, you get down. So it doesn't just drop by like 23%. And by the way, if you look back in February to April, the S&P dropped by 19%. So that's a big drop. And, we experience that, all of us. So it's not like, it kills you. So I wouldn't worry too much. In fact, let's look at that. So, yeah, 19% on the tariff thing. And you look back now thinking, I remember the wobble, but did it really stress me or kill me or kill my portfolio? So no, and like I said, in the S&P 500, it pretty much goes up 2 or 3 years, and then drops for 1 year. Not like that, but the stats, every 3 years drops 1 year. So, and it averages, even with the crashes, about 10 to 12% a year. So, I wouldn't worry about a crash. If you got some cash, it's an opportunity. But I wouldn't worry about there is a little. The only thing I can see happening here, a little worry, is that when you get a very bullish market, especially in America, 60% of people own stocks in America as opposed to over here 30%. So people feel good, they feel flush when the market's rallying, and you tend to get more people, going on margin. That's a worry. And when you get big sell-offs, then those margin calls come in and it accelerates the downward trajectory. So that's why you tend to get big falls after long big rallies, because you get all these margin calls and it accelerates the downward sell. But I wouldn't worry too much about these things. I've experienced some big drops in the past, and mostly I've been all invested when it happened, and it's been fine, really. It panics you for a while, but the bounce back. And also, I said this, Steve said, the trouble with trying to sell at the top is you'll miss the bottom. And what happens is you get very aggressive rallies off the bottom like this. And if you miss that, and you've sold and you start buying up here and it comes back down, then you've missed a big chunk of gain there. So it's very hard to time the top and bottom of markets. I mean, there's no point going. And also, you don't have to go all in or all out. If you're a little bit worried, just take a little bit off. You don't have to go sell everything. Just take a little bit off. Reduce your holdings a little bit. And that's the thing with that's why I hold a small amount of stocks at the moment, because Andrew Ross Sorkin, that's it. 1929 and the big fail. Yeah, that's it. Thanks, Mark. Andrew Ross Sorkin. Yeah, it's worth listening to that interview. So we tend to worry about these big crashes, big falls. I mean, it's a lot different from 1929 and places like that. Like I said, the very banking system was we're worrying about failing in 2007, 2009, and in Great Depression, there was hardly any banking regulation. There was no tier one, capital banks that have to hold all that stuff. So it was a big worry, and people were betting on leverage as well. There's a lot of leverage in the system back then. I didn't realize that, so that's the problem. Anyway, so don't worry too much about crashes and things. People say, "Oh, always will crash." If you've been investing for like 10, 20 years, you've experienced plenty of them, really. And the stock market always goes higher. So it's an opportunity to buy stocks, pretty much. I tell you what's come off as well. Global uranium funds come off a bit on the sell-off. I do like iShares UK property. I think that's going to do well over the next few years. It's SEGRO, basically, data. Anyway, so that's, I try to keep my losers small, like I say, I try to build up, if I can see good visibility going forward, I try to buy some more of stocks that are winning, and so they get a better weight. So I've got quite a few losers in there, but, like I say, if you look here, I've only got 9 winners, 40%, 8 losers, only 20%. So almost double my holdings are in winners. I've got 32% cash. So there. I will be sorting this out again. Now I'm very happy with how the scores, the algorithms working. I'll look at the performance of the top 25 over different metrics. Like I said, this should change a lot less now because some of the stuff is based on forecasted revenue, unless they have trading updates that goes badly. But anyway, I'll just go over this quickly. So the potential score, if you're not familiar with this, incorporates the next 2 years. It didn't. It incorporated the next year. So I was worried about it. The further forecasts go out, the less accurate they become. But for certain companies, like for example, as RAMSDENS or Personal Group, high sort of predictable revenue. Personal Group recurring revenue of about what 80, 90%, 90%, isn't it? And RAMSDENS got 170 shops to do trade constantly, websites. So you can sort of predict revenue quite easily. So good quality businesses have a predictability of revenue. So they're never going to sort of shock to the downside or just stop or big contract cancel. Doesn't happen like that really in some ways. And just to explain, if you're not aware of the MicroCap League, the top score any company can score is 100. Okay, this determines the position they're on the MicroCap League, and they're all scored on potential growth, value, momentum, health, efficiency, and that builds into the score. The largest contributor to the score is potential. I've increased it to 45 because it just makes a lot of sense, really. Why am I scoring on backward metrics? Of course, because it's more important to think about what's going to happen rather than what has happened. And of course, this is what you need to know. Okay, a company may have reported good revenue, good growth just then, but will they continue to do that? Because if they don't, the share price will go down, full stop. It's not based on what they have done. I mean, it may be for a couple of days if they post good results, but most people know those results because the trading updates come up. But then it's always looking forward all the time. So I'm thinking they could even, expand or extend that potential score even greater. But I've kept it at 45%. I don't want to move it too much. And if I do adjust any scores, it'll be slowly increments to see what happens. But so I'm just saying the same thing. So even though companies are all scored on 6 metrics, by the way, under these 6 metrics there are 15 subcategories. Potential is the highest weighted category. Next 2 years, so it's next year's forecast and the year after next forecast. And I noticed a bit of an issue with this as we come towards the end of the year, because most companies will say the forecast of the end of this year. If their end date is 31st of December, then the forecast for next year 25 is almost, it's done, isn't it? We know what it's going to be. What's next year? So it'll be good actually when you start getting companies coming out with results, because that's when brokers tend to upgrade forecasts for the next 2 years. So then we'll have 26 and 27 that play into the scores. So next year's is still weighted. So next year's is still weighted a bit more heavily than the year after's because they're more predictable. So out of 45 of 100, there's 25 points for next year. Year after next, 21 points. So just slightly below that. And like I said, how does this affect the league? Well, it's in play now. It's on there. Companies' positions will change. They have, not hugely. There's some companies that are weak next year's have dropped, which is good. So, of course, companies with forecasts showing strong next year, but a year after will drop. Companies that only have 1 year forecasts, then they'll drop as well. This is due to the company having less visibility on their revenue and earnings, and that's what investing is about. You want to have a guarantee of a certain amount of revenue or predictable earnings going forward. You don't want to be living, sort of a couple of months to couple of months thinking, oh, what's next year going to be like? Because that's a higher risk. Like I said there. So it'll highlight companies with an expected longer-term potential. In short, it's because they expect to do. There we are, next 2 years. So, yeah, so I'm quite happy with how it's shaped up in the companies now that are. But I always look at all the forecasts. Like I said, if you look at the database now in the MicroCap League, it's always worth looking. For example, you may have a company on page 2 or 3 that's okay for next year and the year after, but the year after, if they got 3 years forecast, maybe blowout. So, like KROMEK, for example, had a very good year this year, but next year is going to start. It's a contractual business, good technology they have, but if you look, for this year they had excellent growth, which was scored on. Then next year they have this big contract from Siemens. It starts to drop. So next year's forecast only 2% growth in revenue, where they had 37% this year. And so net profit growth is going to drop by 47%, and then they've got a PE of 24. Whereas now they're at PE 13. And then the year after, I think its top line is 13, but again, 60% drop. But again, if you can, worth looking at, that's only got 2 years of forecasts. But it's also worth looking at the third year forecast to see if there's anything going to change, in the next few years. And so all companies basically now are, on the front page, you will see. I mean, the funny thing here is CakeBox, for example, very good forecast next year and the year after, okay? But last year, they marked down on because it wasn't that good. The next 2 years are very good. And they're going to be a forecast P 15, 12, pretty much where they are. So you think, okay, that's good because they've acquired a company, of course, and they expect that kind of revenue growth. It's not nailed on, but it just shows you. And a good trick to do sometimes is if you go to page 1, let's have a look. So if you look at potential and order by potential, okay, and there's a good thing. For example, look at companies with a high potential and growth, but momentum is not good. We know that ASHTEAD, for example, its momentum is non-existent. But if the fundamentals are good, sooner or later, momentum will pick up. There may be some technical reason, seller, something happening, and they change from AIM to the main market. There's also some shorters in there. So the fundamentals are good. It's only the chart. And sooner or later, the chart tends to catch up. Unless they come up with a trading update that's below expectations, then it should move. Momentum should move. Same with Hercules. I've been looking at Hercules for a while. I can't pull myself to buy it, but I'm thinking it's a good forecast, and it's starting to kick up here a little bit. You can see here it's starting to sort of try to get up there. But if you look at the numbers here, and even the last set of results, so top line 10%, 75% net profit growth for next year. Year after 15%, and this is basically supplying labour in infrastructure and all that. So they'll do well with. If you click this link here, by the way, it should take you to the MicroCap database thing, and you can see the last bit of news. Another record year expected investment. UK ramps up. He owns a big chunk of shares. Hercules again will deliver record results with more forward. So they're involved in big infrastructure projects. Size will see. So I'm thinking, yeah, it's come off a downtrend. Is the downtrend about to end? Because the fundamentals look okay. The good growth, good value. Okay. So anyway, yeah. So anyway, look at the company summaries. In fact, let me just scroll there. Hang on. Any others there? Hang on. Oh, I want to share share screen. I'm trying to share my screen there. Oh, yeah. Potential. Yeah, so it's a couple there. Hercules, SYNECTICS as well. Good value, everything, and the momentum's not very good at the moment. The momentum's just, for some reason, it's rallied hard, and it's coming back a bit, and it's having a little bit of a range. Get a range, uptrend, to there, range, uptrend. You always tend to get it overshoots on the big upside, and it comes back into a sort of range there. But now, Synectics, for example, it's looking good on. So next year, 20%. Now, largely they do have recurring revenue, but the majority is contractual, so they rely on contracts. So this could be upgraded, of course, with new contracts. But at the moment, it's a PE of 10. That's cheap. It's still going to grow single digit next year after next, but it's still cheap. So I'm just thinking any big sort of decent contracts there will revert to growth again. Then go back up. But worth keeping an eye on. Decent company again. Very good balance sheet. They got the cash flow, 9.5 million cash, and it went up by look at that free cash flow up 302%. So all good numbers last year. There we are. Anyway, so hope that makes a lot of sense to everyone. Does it? Just check out all the forecasts and just make sure you also just read. Read all the trading updates. Make sure it's going ahead. Don't just rely on the website there. Time to sell when the shoe shine boy was giving tips. Someone once said, "Yeah, I know." In fact, someone did say that on the. I think it was on CNBC. Someone said they recognised one of the presenters, I think, on CNBC in the cab, and asked him for some tips or whatever. And he's thinking, "Oh, that's a bit worrying." But yeah, but I did say this on the podcast yesterday. But jobs, it's not growing, it's not stalling, it's not falling off a cliff. Apparently, according to the head of the Fed, jobs not falling off a cliff. They're not growing that much. But the consumer in America, which is a service economy a bit like ours, they're very buoyant. They're still buying, and I thought, well, a lot of that is because they're employed, and when you have 60% of the Americans invest in the stock market, they're probably feeling quite bullish, aren't they? It's like over here, you own a house. And if house prices go up by like a crazy amount in a couple of years, you just feel a bit more flush. You think, oh, I've got a nice bit of property there. And with stocks, it's even more because it's more liquid. So I think people are feeling quite confident and buoyant, the people who own stocks. Now, what happens when the market starts to sell? Then you pretty start to find it has an equal, negative effect on spending as well. Because if people, if wealth is tied up in the stock market and that's going down, you find people tend to be cautious about spending. So a lot of it is tied up in, the real economy in America and the market is tied up together a little bit. When sentiment is good, then of course the markets are strong. Then people feel confident, bullish, and flush. Okay, portfolio losers and what to do with them. Okay, was there anything else on there? No. Okay. So I have 4 companies that are showing double-digit losses. They're those: ASHTEAD, CML, MICROSYSTEMS, DSW Capital, WARPAINT London. So what to do with them? Firstly, I keep saying this a lot. There's, investing should be a long-term game, mid to long term. If you want to, try and be rich overnight, be careful. You probably get poor overnight. But if you're looking for 100% rises in a day, you can get unstuck with that. So the only protection if you're a long-term investor, pretty much an investor against the share price dropping is, I keep mentioning this more for myself than anyone else. The only protection you have is portfolio management, essentially. If you go, or like I say, it's no brain science. If you go big in one stock, this is the one, this is the winner. And like I said, there's this almost emotional attachment to a new investment that you think it's the winner. And I do explain, why would you not invest in it if you didn't think it was going to make you a lot of money? And so we tend to go a bit bigger. So it's a bit of a discipline to say, stay small, because you never know. You never know. You never know what's going to happen. Bad trading up. So if you go big, your loss will be big if it goes wrong, essentially. And this will drag your entire portfolio value down. And you obsess on it because, of course, this one stock is, and you may even try and buy more and think, oh, you try and get out of this. So, having big positions affects you emotionally, it affects your portfolio, it makes you do irrational decisions. So if you just have a small position, it's fine. And you can afford to make mistakes as long as the mistakes are small. If they're big, you can't, pretty much. and you have less optionality. If a company is big, you can't average down. If you can't manipulate the share price by averaging down because it's too big a size in your portfolio to really manipulate that average buy price. So when the share price starts performing, you can buy more if the company goes down, if it starts performing, okay? I say when there, but if, I should say, if it starts performing, you can buy more. Like I say, over 3 to 5 years, that's what you should be looking at. So start small. So I made a mistake on the timings of these companies, probably. I'm hoping it's the timings. I mean, let's be honest, the biggest worry you have about investing in a stock, right, is the biggest risk of all is, will they go bust? No, I don't think any of these companies will go bust. They've got cash, they're profitable. And so at worst case scenario, they're having a soft patch in their things. Will they turn it around? Well, all companies are trying to turn it around. All companies are trying to improve and get better. So I'm hoping this is just a blip. They'll come around and they'll end up performing better in some, I don't know what time frame. Hopefully, it'll be the next 3 to 6 months, maybe a year. Who knows? So just an example, WARPAINT London, for example, is the worst performer there. Let's say your portfolio is worth 100,000. I always say this, maybe less, maybe more, doesn't matter. These are round figures. 3% is, 3 grand. 30% down means it's worth 2,100. That's a loss, a paper loss of £900. That's 0.9% of total portfolio value. So it doesn't have a big effect. The day that they came out with an update, which is a bit of a profit warning, it dropped by about 25%, and my portfolio value total went up because some other stocks were bigger and just rose a little bit more, and so it didn't really affect my portfolio value. So whenever you buy like 3%, it's more you're hoping it'll do well. Not quite convinced yet. It's just a placeholder kind of thing. And like I say, why 3%? I don't know. If I think a bit more risky, I go less, but I start off by thinking 3% is enough to care, but it's not so little amount that you just buy loads of them and just don't really do any research, because you can do that. You can just buy and buy. You buy in small amounts, tiny amounts. You can buy loads of companies, and then you don't really care too much. And then you focus on quality. Then it's more about quantity. And just an example, if you got £1,000, you got a stock that's up 6% of your portfolio, and it gets 30% up. That's £7,800 worth. So paper profit 1,800, and that would cover a 30% drop, in that and more, and you still make a profit. So the bigger a company gets, the less it has to make to cover the losses. So it's the power of size and numbers. What you don't want is a big company going against you, because then you've got to have some other bigger holdings to cover that, and you can't do that. It's hard work. So you want to make sure small companies, loss makers, stay small essentially. So secondly, firstly was portfolio management. Secondly, is the original investment thesis intact? Is why you invested, is it still looking okay? Is there still growth and value there? So let's have a look. Is ASHTEAD, right? On 26th of August, interims, the board expectations remain in line with those set out in the trading update of 17th of July, confidence underpinned by customer significant backlogs. So let's have a look at ASHTEAD here on the old, in fact, let's go to the database here. It's easy to search. AT. So scrolling down, it's going to do 23% for this year. Top line growth. It's going to do growth of 32% profit before tax and 22% net profit growth. Okay, it puts on a PE of 7, EV earnings of 11. Now, I think that's a decent valuation for that type of growth. The growth is going to be less, pronounced in 2026, but nevertheless, it's PE of 7, EV earnings of 10. So I'm thinking that's fine. With that kind of, it's not right. Try and find many companies out there. They're growing double digit this year, single digit next year on a PE of 7. There's not many of them, and EV earnings of 10. So that's with debt. Something it's not as if I bought something that's way overvalued, has no growth whatsoever. It's going to go into a loss. So I'm happy with where it is. It's in a hell of a downtrend. It's the most shorted stock in the, and you find, like I said, most shorted stocks, if they do have a rebound, the shorts come off them quite quickly, or they start reducing very quickly, and you tend to get a very aggressive rebound. And so you could see this going, running very quickly, very soon. So you'd be surprised, even though it's like be 20 or 30% down, and it's not a big position in your portfolio, it can make up that ground very quickly. It's when you get sort of 90% down. So, as long as it's not a big position, it's not a big problem. So that's that. Now, CME, I bought this recently. I've only got small on this because it was more to do with, I like the area they're in, the contract business. They just announced a £30 million contract is over, sort of, what, I think, 10 years. But they have the potential to, land some of these big contracts. And they do say the board is pleased to confirm the company is on track to meet management expectations for the current financial year and is therefore expecting to deliver a marginally profitable performance weighted towards the second half. Now, this company's been a bit of a restructuring company for a while, launching new products and stuff like that. They've announced a contract. They've also, worth noting, so my biggest concern here is that they were making a loss, but they're sort of slowly turning it around. They are like a 36 million enterprise value because they got cash for 9.9, and this doesn't include the sale of a property they just made. They've sold a property for now 7 million. So the problem here is they made a small loss last year. We are going through a sort of turnaround. There's no forecasts. They do think it'll be marginally profitable, okay, and that's the thing. So that's why I've gone sort of slow, small on this, 1.4%. But I think any positivity, because they've had a rough couple of year and a half, could move this up. I did say it down here actually in the comments. I'm not expecting a lot. Their interims are out soon, but it's one of these companies I mentioned last week. Higher risk, higher reward, because there's a contractual business that could land some big contracts. But like I said, what I have is this buffer. Probably now, I think they have how much money is coming forward. I think they're 3 million and 4 million, or 4 million and 3 million. So there's the contract. Oh, right, yeah. £7 million they sold the buildings for. 4 million being with immediate effect, a balance of 3 million year after. So they've got like 13 million, and they will have about 17 million of cash. So there's plenty of runway for this company. They can go on for quite a few years at this loss-making rate of, sort of 18 grand to win a contract. So I'm quite convinced they may land a contract before. So it's more of a bit of an educated punt on a company with a good balance sheet, hopefully decent products. So they are going to be marginally profitable. So they are waiting towards second half. Oh, wrong way. Oh, what have I gone there? Oh, I've gone up to right. I don't know. I don't want to text. I don't know what I did there. That's CMC. So DSW. They said on the 8th of July, while mindful of ongoing global macroeconomic uncertainty, so this is just checking on each company that the fundamentals are okay, even though technically they've gone down, the chart has gone down, I'm underwater on them. So just recheck again the last set of information and see if it's sound. They're currently trading in line with expectations. The board remains confident in the prospects of the business in full year 26 and its strategy to build shareholder value for the long term. 2.7% holding, 20% down. Let's just quickly check DSW. When's their... It's the 24th of the 11th, so this month they're coming out with things. And if you look at the forecast, they're showing hopefully 60% top line, 86% bottom line growth, puts them on a PE of 7. So they've got good growth, good value. And in fact, I did have recent communications with James Dow on LinkedIn about, do you remember it dropped? It dropped like crazy. I mean, it's a very liquid stock, so it'll move around a lot, but it dropped. I think, what's going on there? And I think it was there, wasn't it? Yeah, it dropped by like 15%. What's going on? So I did email him, contact him via LinkedIn. And he obviously, I said, I can't say anything, we're in a closed period, but if there's anything abnormal, we'd have to report it. So basically, if a company has a profit warning and they have expectations of the market, and they're not going to meet those expectations, they have to announce it to the market. If something news come up, this changes focus. So you can assume they are in line with these, and that's for a PE of 7. So in my mind, yes, the share price is very liquid. I mean, I could have bought them a bit lower, but I think they have the potential to go up quite strongly, especially now the old director is hopefully out, because I think he had less than 1.5%. the old director, when he last sold some shares. So any drag down, maybe he's got a few left to sell, who knows? But when was this? Director, 29th September. That's no, he bought some. James, oh, there we are. James Dow bought, how many value? 120,000 at 52 pence. So over 60 grand's worth. James Dow bought. And that's probably the last time he could buy. So where are we? October, November, December. Sometimes it's 3 months. I don't know what is what the cutoff is, but it's probably the last time he could buy before the results come out. So it's quite a confident buy, isn't it, from a director putting 60 grand in, now holding 16.95% before results come out. But the other director, where is it? Jonathan Schofield. So on the 30th of September, he went down to 1.49%. I don't know why he's even reporting that now, because you don't have to do that anymore. So I'm assuming he's nearly out now. So I'm hoping, a bit of good news, will move that up. And WARPAINT London, on the 10th of September 2025, they said the board now expects the company to achieve revenues between 107 and 112 million, and EBITDA between 23.5 and 25.5. So let's have a look at WARPAINT London quickly, see if it's lack of growth or the lack of value. I'm ready. Here we are. So they're only expecting sort of 9% top line, and that's going to dip by 13%, but they're still making a net profit of 15.9 million, and they also pay a dividend of close to 5%. So there's no worry. It's in financing. They have plenty of cash. They're a profitable company. Okay, there's no growth in net profits. A lot of they're saying was down to a couple of reasons. It can be excuses, but it's not, so we know it quite well. Currency effects in America, of course, has hit a lot of companies. A weak dollar, which is strengthening now, actually, which should help them. There's also the H1, which is a bit of a nightmare for them. They had, of course, the trade tariff war, and all this stuff is produced in China. And so effectively it stopped all trade between China and America. But now they've got a big rollout stores happening in H2. So I'm quite confident they'll hit these. And I think now, after being downgraded, if they put expectations in the market, I don't think they're going to be, overly optimistic. I think they're going to sort of, under promise and over deliver, hopefully, if they're sensible. But yeah, PE of 11. Like I said, this at one time was on a PE of 45 or something when it was growing. So when we're now on a PE of 11, EV is at 10. So, and they get back to growth both in top line, bottom line for 2026, and we're on a good valuation here. So I'm happy where I am in these companies. It's fine. I'm not, they may not have a turnaround in the next month or 2 months, but it could be 6 to 12 months. But I think there's very decent upside in all of them, to be honest. And thirdly, only buy more if the company hits or exceeds these expectations. So the things in the market there, things you see on the website, if they don't hit those numbers, then it's probably not worth buying anymore because they're not improving, essentially. But just an example of averaging up and how you can change. Like, so when you start small, you can change your average price quite easily. Let's take the worst performer there, WARPAINT London, 29.32% down, okay, 2.2% of my portfolio. So resistance, you can see it pretty much there. It's trying to get over that the week twice, 250, and come off it, okay? So maybe go sideways and down for a while. So look at this. I bought a 320, okay? If it rises to 250 on that trading update or in the year, then I'll be about 22% down then. If I buy another £3,000 worth, so let's say I started off with 3,000, 3%, another 2%, add another 3%, 5.2% of my portfolio, I'll be 12% down, okay? So I'm still down, but it's a lot less, 10% less than 22% down. I will only need 10%, 12% rise to break even then. And if that's off the back of a very good trading update, I feel very confident in a profitable company with decent amount of cash, putting a bit more money into it. And in fact, it did 12.68% in one day last Friday. So that's easy. And to be honest, I think if they come out with a very bullish, above expectations trading update, it'd probably do 20-odd% in a day. So, when you talk about small microcap companies, they can do that in a day. So I wouldn't get too worried about, if a good company is turning around, about being too much down, as long as it's not a big position, If they don't hit their expectations, the share price drops. In a worst case scenario, it becomes less significant share of my portfolio, goes on 2%, whatever, and therefore it has less of an effect on my total portfolio value. I'll only increase my holding when it starts to win on good fundamental data, and that way, I know it's going to go in the right direction, not the wrong direction. Because if I go in the wrong direction, I shouldn't increase. There we are. But hopefully that makes a bit of sense. So always a plan to start off. I think the trick is don't go big in anything straight away, because it takes you a while to learn about companies. It's like the longer you hold a company for, the more you get to know it, and you read more trading updates. You learn a bit more about the business, about the management, and so you realize that maybe there's certain things you didn't understand first of all when you first invested, or there's a bit more upside than you thought, or maybe even less. You don't know. So it's just, you start off small and start learning about the company. And a good way to learn is to have a stake in a company, and then you got skin in the games. You have to learn about it. But anyway, yes, let's have a look at the CTF. I was surprised. I didn't understand why it dropped. I think it was because that blue sky. I mean, who was it who asked for this? Is there any reason why it dropped? I mean, that resource, the blue sky play, they've moved out of the business, haven't they? And they've almost removed the upside from it. That's what I read. So let's look at the ZOTEFOAMS. 180 million market cap, 204 million enterprise value. So what was the last results? They had 21 million of net debt, but it's fine because they're making a free cash flow of 5 million. So all metrics they improved, and this is where it shot up, didn't it? A bit of a surprise. I think, yeah, there it was, shot up. I did say back then, I mean, I removed the comments afterward, but this is looking like a decent upside here. But it's come off the last few days on this update. But if you look at it, like I say, growth of mid-single digits next 2 years, but profit's going to turn around. I think it's because they're spending a lot of money on that resource, wasn't it? That packaging stuff. Look at that, 680%. So fundamentally, 11 times P of 11, and EV units of 13, and they are paying down debt, aren't they? So it is improving. You can see it's improving, and it's good value. So I would, I don't know where it's going to settle down, but like I said, that was previously where support and resistance was. But after results out, trading update. So the trading update talked about, which I think, let me know, was it because they got rid of this blue sky play? Hi, first time coming and recently got onto the market. Very nervous. How long do you usually sit and accept low negative performance? E.g., I think your portfolio flashed up for time. Shows you've held for 2 years. Yeah. Well, in time, to explain, I have taken that portfolio thing doesn't really reflect. I did hold 22% of my portfolio in RAMSDENS, for example, and I was in decent profit, and I took some off, and now down to 6%. Time, I was also up in profit. I was taking some off, and personal group. So I think a personal group I had about 16, 17%, and now I'm down at 5%. So I've taken cash profits along the way, But I believe if you've got good company, again, it's not a binary thing. It's not worth buying all, selling all. If if you start taking up a decent chunk of your portfolio and you feel a bit nervous, take a bit off, because it's still a good business. It's just personally, you may be worried about the size of the portfolio, the holding you have. Like I said, when RAMSDENS would take it at one point, 25% of my portfolio, it would move my entire portfolio. And even though it was winning, I didn't like the ups and downs every day just from RAMSDENS, So yeah, I've been in a bigger sort of profit and time than that. But again, I'm holding because it's a small position, and I don't think that it's reflecting the good fundamentals. So I will buy some more of that company if they come up good and the momentum changes, and I could take it 10% of my portfolio, whatever. I mean, I only put sort of limits on it. I mean, I say over 9%. I don't really want to put more than 9% into it, but I will get, if I see a potential in the company, I will go a lot bigger than that. 20. Like I said, I did hold 40% of a company at one time. I wouldn't go all into a stock, but I mean, yeah. So that portfolio thing doesn't really, even though it shows you the amount of time I've held it for. I've held bigger positions and taken some profit off, in the meantime. So yeah. Uh, Great patience, but probably not performed as expected over a long period. No, because if you look at the time, I bought, as I said, when I bought it, I mean, it's come down now from where it was because I think I averaged down and averaged back up. But I mean, um, when did I buy time? It was like 2 years ago, wasn't it? Let's have a look. But at one point, I was like 20% in profit, and I've reduced positions in it. So yeah, I think I've had it for a couple of years now. So and I averaged up a little bit, but I was in profit and then took a bit off. When I'm holding less than 3%, I don't really mind too much where it is, like I said, because it doesn't. All I'm looking to is scale up sometime. And will I do it right now while it's doing this? No, because it's in a bit of a downtrend. But I'm looking to all those companies at 3% in my portfolio. I'm looking to scale up sometime. That's all. So at the moment, I don't really care where they are. When they start getting some bigger positions, then I have to be more confident they're going to perform longer term. And so I get a 5-6%. So once you get a 6-7% up, or say over 5% in your portfolio, you have to really double that position if it goes wrong. And so it starts getting a bit scary then, So always start off small, and you can once you'll know when they come up with good results. It'll power up. The momentum will change. They have a big up day, and you think, right, I'm going to buy some more on that day. So it's a lot easier holding companies you know quite well and just moving your positions up and down in them rather than having to do new research on a new company and then not really knowing about it. So time is a good business, like I said, and most of the companies I hold, I think, good businesses. It's just sometimes the share prices go down. So, okay, so they go up. So it's just moving the levers really of leverage on position sizing, not leverage, I shouldn't say. So yeah. Um, CTF, lots of speculation a few weeks before. Sorry, Tom says lots of speculation for a few weeks before results on new product. Gave it all back on the announcement. Yeah, but the results. Yeah, yes. So Duncan says that is a resource was the blue sky opportunity, wasn't it? Um, but the fact is, it's funny, isn't it? People love a bit of hope, high potential, don't they? Because ZOTEFOAMS were spending, I wasn't over this, but I think they were spending quite a bit of money, weren't they, on this resource stock, resource thing, and it wasn't sort of going anywhere for them. But people liked the idea of the upside, and they had a nice little business underneath. They were spending a lot of money on it, and then they announced today, didn't they? But basically, um, yeah, where is it? Resource, yeah. So some of the management from Resource, the guy who was in charge of it, Resource, they've not committed further the packaging technology. The group has remained open to enable, yeah, has formed a company called Resource. So the guy, a former, including former ZOTEFOAMS business lead for Resource, they formed a separate company. The group does not expect to receive any consideration for this, nor provide any ongoing financial assistance to the consortium, but has retained the right to receive a cost-free minority stake in the business should it succeed. But I just know how much they're getting. To me, that's not a bad thing because now they don't have to spend lots of money on it. It obviously wasn't gaining commercial traction, but if it does gain commercial traction now, then they have a stake in it. So that's still upside, and it's cost-free upside to them, whereas before it was costing them. So I understand there's people maybe disappointed it wasn't getting, but it's obviously they've tried their best to, some of these. Like I said, there's always good ideas and amazing thoughts out there, but they've got to get commercial traction, and that didn't as yet. So I think that's it won't affect the day-to-day operations of their business, which is improving, and yet they've got that potential blue sky opportunity. If it's as good as they say it is and it takes off, then they could probably invest more in it if they wanted to. Well, no plans to do so, they say. But I tell you, if it starts taking off, they probably will invest in it, won't they? So they can change. No plans to do so yet, while it's not gaining commercial traction. So there's still that upside there. Um, one more then, quickly. So, sorry. Yeah, remaining ZTF business is very good. And it's funny how investors, are not compelled to buy a good business doing quite well, but they're compelled to buy a company that's not doing well commercially, but has some dreams and hopes around it, But yet they've still got that. They've still got the option to have that happen. So I think ZOTEFOAMS is a decent, investment at this level. Um, uh, and quickly, I think it's worth watching. If you're not into it, ADVT come out with results that didn't seem as good as they thought they were, but I'll explain. So this is Vin Maria. Vin Maria, of course, she's was one of the richest women in the UK, and that was mainly down to her creating these businesses. And what she does is an acquirer of businesses, software as a service company. They look for EBITDA and cash flow accretive companies that have sticky customers, okay, and they acquire them. Now they've got 252 million market cap. In fact, they've got 96 million net cash. So that's a lot of firepower to buy and acquire companies. They're very disciplined on what they buy. They won't overpay. And in fact, they said in their results, they run the rule over quite a significant potential acquisition. They didn't go ahead with it because it wasn't the right price. And I like that. But I think, I just got to look at this lady's track record. So the results down 63%, but that was largely down to a gain last year on their investment in M&C Saatchi of 4.2 million, I think it was, and a loss this year of 1.8. So if you take that off, it's pretty much the same. So top line grew by 28%. So it's basically it's a bit of a tax, I think, bit of an adjustment there. And like I said, look at free cash flow, 6.481 versus outflow last year. So it's going well. I mean, it's not cheap. In fact, ignore next year because this full year, of course, is going to, fold in that reduction on their investment in M&C Saatchi. But then it rebounds the year after. And like I said, on the EV earnings, they're 15. And I think that's undervalued considering what they can acquire. And if you want to look at Vin's track record, it's phenomenal. So she started here literally as a graduate, and then she becomes COO, and she's quite full of herself. But you would be. She reckons she was responsible for most of this, from 3 million market cap to 1.2 billion. Right? So she didn't get any credit, she said. I interviewed her a long time back. And so she said, I'll do my own company, I'll do it myself. She took computer software from 1 million to 500 million. That's 49,000% return. And then she did it a third time. She went from 3 million to 760 million, but this was further sold after she sold it for 2 billion. So I don't know what that is, obviously 50,000%. And she says 18% stake she had in that, made 140 million personally, one of the richest people, one of the richest females in the UK, self-made. And she says she always looks to last for success and wants to beat it. So be aware of this company. Like I said, you've got to give someone like that a bit of a premium for track record, but I don't think there's a premium there. There's like EV earnings of 15. They're going to be doing that's what all they're about is acquiring, improving. They've got a team of 25 people in India, coders and all that to improve all the systems and software, and they bring it together, and so they fold it into their other products, and so it's a better cross sell, upsell. Like I say, what I like about it, software as a service, very sticky clients, and they're all sort of EBITDA positive pretty much, and high recurring revenue. But I think I'm not saying she's going to do 49,000% or whatever, but I think it'll be a multi-bagger over many years if she does what she's done over the last few years. Like I said, what's nice is they have that massive firepower. I don't know why she's invested 92.2% in Saatchi, which is a little bit undervalued maybe. But and that's what's dragged the share price down because Saatchi's gone down the share price. But I mean, keep an eye on that. It's I think for longer term, sooner or later they're going to announce an acquisition. Maybe they've done a few small ones here and there, but I think once they're obviously looking at a big one, and they've got a lot of firepower with, like I said, 96 million of cash on the balance sheet. So I kind of I say even on these results, it didn't really. It's just one of these things where you see a very good business person like Ben, who's well, in fact not very good. She's exceptional, and it's risen nicely, ahead of expectations. We're now in a range. It may have to go sideways for a while, but sooner or later it'll sort of break out. But I think at this level, paying 15 times for what Vin has done I think is quite reasonable. Anyway, thank you everyone for joining the webinar. Hope you're well. Hope you don't get scared by the bankers out there. Hope you get some sleep tonight. And we'll speak you next weeky. Thank you very much. See you soon. Okay. Raoul, see you. See you, Raoul. Thank you. Thank you, Barry. Thank you, Darren. Thank you, Alex. More food for thought. Thank you, Duncan. James K. Thanks. Later. All Pete, Kristen. Thanks. Thanks. Stayed for the whole session. Well done, Darren. Lord Stock. Thanks, fella. Cheers, Lord Stock. Thanks, Winehouse. And I'm off now. I turned the heating up in my room a bit too much here. I'm starting to feel it in my cheeks. My cheeks are all red. Anyway, that's enough for me. Bye. Speak to you next weeky.